So today we're going to be discussing how long a trading bot or strategy can work for. One of the most commonly asked questions I get as the founder of an EA development company is how long will this particular EA last for? How long is the strategy valid? Will eventually it stop performing in the current market conditions? And because of that, I wanted to make this video talking about a few factors which lead to longevity or short performance in a certain EA or trading bot. Because it really depends. If you make a bot which is very robust and has a strong strategy behind it, there's no reason why it can't last for an extended period of time. However, if you make something which is perhaps very based on a certain market condition, perhaps it won't necessarily last nearly as long. At the same time, there are certain types of strategies, just in terms of whether or not it's a scalper or more of a swing trading bot, which are inherently more sensitive to small fluctuations in price movements. So with the whiteboard behind me, we're now going to go through a few key factors which can help us answer this question. So the first one here is really the market regime. One of the main reasons why bots stop working is because the market regime changes. And a market regime really refers to all different kinds of price action caused by an underlying fundamental driver. And this could be the trend. If you're in a strong uptrend, that could be a certain regime. Consequently, being in a strong downtrend could also be a certain type of market regime. We also have to look at the volatility. Having a period of incredibly high volatility could also be seen as a given market environment. And finally, if we're in a high VIX or a low VIX environment, which means more of a risk on, fear on market, or more of a calm, a slow, a steady market, this will also impact the regime. So a great example of a market regime would be the COVID-19 pandemic. So that initial panic sell was really this super strong downtrend with incredibly high volatility and incredibly high VIX levels. That was a great example of a period where more shorting type strategies or more like downside breakout type strategies would have done incredibly well. At the same time, 2022, for instance, was a very boring kind of downtrend, but very choppy. And this was largely due to the fundamentals of being in more of an interest rate hiking cycle, which was leading to not a super rosy bit of price action, but also not a panic. And that's what led us to this very choppy, but also downtrend type market. And now in terms of other types of regimes, fundamentally, you can have more risk on or risk off assets, and this will ultimately impact how a bot can perform. So let's say, for instance, a bot was trained on a very risk-on, very bullish market environment. If all of a sudden we switch to a regime which is much more fear-based, perhaps the price action is totally different, and the bot stops working because there was a switch of regime. So one of the main things to look at when asking ourselves this question is, was a bot overfit or fit specifically to a given market regime? If so, it might stop working once that regime changes. However, if it's a very versatile bot, which has been tested across a broad variety of regimes, it could very well perform for a super long period of time. So that's really the first point. If a bot is fit to a given regime or is more diverse, that will be one of the main factors regarding whether or not it will be a very long-lived bot or if it's going to fail a bit more suddenly. Our next point here is asset prices. And this is a big one which people are less aware of. If you develop a certain strategy and it's heavily influenced by the given price of the asset, it's likely to not work as well going forward. So to give a very concrete example, if you're using a fixed points take profit or a fixed point stop loss, and you trained the bot, or you developed the bot when gold was priced, let's say, at $2,000, if gold all of a sudden becomes $3,000 an ounce, and you're using the same TP and the same stop loss, your bot might stop working. And this is simply because all of a sudden a 5-point move relative to the price of the underlying asset is now very different in percentage terms. And quite often, assets move in percentage terms because it's relative to how much they're worth. So if you kept your fixed levels the same, it might no longer work if you significantly change the price of the asset. And that's why if you develop a bot, putting in exit levels based on percentage of price, based on true range, based on ATR, can make it significantly more robust than doing it simply based on fixed points levels. And this is one of the factors that will make a strategy work significantly longer into the future. And finally here, a great example is just good old overfitting. So what is overfitting? This is a perfect example if we can see it here actually. And overfitting is if you were to take historical data and you fit a strategy perfectly to that historical data. So let's say you run 6 million optimizations, and over the past year, if you bought gold at 8:52 a.m. in the morning and you sold it at 8:57, you would be profitable. Obviously, this is completely overfitting and cherry picking historical data, and there's no fundamental reason as to why this relationship existed. So if you do that, your bot is very likely to fail. And you will see this with many bots in the MQL5 marketplace, where the backtest looks perfect because it's enormously overfit to a given period of time. These bots are destined to fail very quickly because there's no fundamental premise behind it. If you have a real strategy, you should be fitting to historical data, but still with a strong underlying premise behind it. So you're not overfitting. So you're using the historical data to guide performance, but you're not completely fitting to it so that you're able to have some forecasting power going forward. To summarize the video, nobody really knows how long a bot can last. However, if it's fit to a variety of different market regimes, if you're using dynamic levels and you're not overfitting and you have a strong fundamental premise behind it, I'd also add usually the bigger your take profit levels, the bigger your stop losses, the more likely it's going to be robust. Whereas if you do something which is very regime specific, based exclusively on fixed TPs and fixed stop losses, and is heavily over optimized, most likely it won't last too long. Guys, hope you enjoyed this video, and I will see you in